check. One more time. Let's try that. Aha. All right. Well, I don't want to get rid of my old headset, but maybe I'm going to have to. All right, then. Good morning, everybody. Right around the world, narrative goes to forced selling of the large cap stocks, taking profits at highs, recognizing the correlation between NVIDIA's threat and the large cap stocks that bought NVIDIA to those levels. Forced selling will take out the Mag 7 semiconductors of all types and could begin a bit of a bleed off that looks very similar to the start of August. It's job numbers week, with today being JOLTS. JOLTS is the take this job and shove it numbers. Job openings and the ease or availability of a job should you leave the one you have. The grass is always greener concept. It's going to be an entire week of job numbers. Some job numbers are more important than others, and a lot of these get revised after the headline numbers come out. But it's the system we have. So as shady and broken as it is consistently shady and broken. So, you know, any of those articles that you read about how the numbers are all screwy because of whatever, well, they've always been screwy because of whatever. So we just deal with what we got. Short week as well. So some of the data points are getting moved around. We should get our crude oil inventories on Thursday, not Wednesday. Should. We'll see if it gets moved or not. We've got a lot of data coming out of Japan tonight. See how that affects us going into tomorrow. And we saw a little bit of a disconnect with NVIDIA earlier this year when a lot of the market disconnected from it. But there's still the tangent connection, one, of just semiconductors all by itself, but two, the Mag 7s. And it's a feedback loop. The Mag 7 were the ones spending billions of dollars a quarter on NVIDIA. And of course, their spending drove NVIDIA up, drove the narrative of AI, and everything just kept running in a circle. Well, if the circle breaks, then what? There's still a lot of talk about the unweighted sectors out there and even the defensive sectors that are still in play. I keep going back to Jackson Hole. Powell said everything's about to change. There's an old book by the guy who created the MACD, Gerald Appel. And in his book, he made it really simple about should we be long in the market right now? And it was, what's the Fed doing? Raising, cutting, or in a pause cycle after raising or cutting? And then where is the S&P and the NASDAQ? Above their 50 or below their 50? It really was as simple as that. It's a good book. It's worth a read. I've got PDF of it. If you want, hit me up later. I'll throw it in your direction. It's an old book, right? But the old ones, the classics, they still work. There's nothing wrong with it. So if the Fed is signaling things are about to change, historically, we've seen markets really go to hell after announcements of these changes. The Fed is always late, always. Always. There's no, oh, it's going to be different this time. The Fed is always late. And if they're cutting, that means they're already too late. They should have been cutting already. They're always late. Always. So we'll see where it goes from here. The narrative can be whatever the analyst is, right? If you're talking to a technical analyst, they'll talk about capital rotation in the sectors and the weighted indexes. If you're talking to a quant analyst, they're going to talk about inflows and outflows. And macro to micro, they're going to talk about treasuries, bonds, and government issuances. And it doesn't really matter what narrative we apply to it. If everything's changing, history repeats itself over and over, then we're going back into a cycle where the Fed is cutting, they're behind the curve, they're too late. Large companies begin layoffs. We go into a recession, and then it's, well, how long are we going to be in a recession? 3 months, 3 years. The ADR this morning hasn't yet expanded because of yesterday's move. We were in a sideways range long enough that it dropped the average daily range down to 80 points. I think it was a week and a half ago that was at 105. It's going to take a few days for that sort of move to filter into this because it's an average of 21 days. One day, one time isn't going to be enough to make that increase significantly. We are closer to the lower edge of the ADR than we are the upper one, which kind of implies we're going to hit the lower one first. We're at the COG line, 55.11 is where we found structure. Right underneath that, we have the round number, and then we have the ADR. So it would make sense to hit that before we do anything else. It's worth noting real quick. When I'm watching the ADR, a lot of times I'm looking at multiple S&P markets. So you've got the ES, and then you've got the SPX, and you've got SPY. Now there's other ones. You can get the S&P 100, right? You can dial that in even more, but usually those are the three that I'm looking at. Yesterday, when we were falling, one of the questions was, when are we going to stop falling, right? It makes sense. It's what everybody wanted to know. And SPY had not yet hit that ADR. Now we fell beyond this, but it was just the point of, do we have room to fall? So here on the right, we got the ES from yesterday. And then we got the SPX in the middle. And we got SPY on the right. In this move yesterday, the ES was already there by, say, 11 o'clock, right? It was really close to it by 11, way past the red line. On SPY, same thing, or the SPX, excuse me, we were really close to that yellow line by 11 o'clock. SPY was still way up here, long ways away from that yellow line around 11 o'clock. It didn't get there until closer to 2 o'clock in that dump where the afternoon really started to kick off. I get it. If you're trading futures, you're probably not interested in the SPY, the QQQ, the SPX, but whatever market you trade, it's connected to something else, right? You're not trading in isolation to something that's not connected to anything. So one of the simplest things that you can look at is other markets that are a lot like your market. ES, SPX, SPY, these are all the S&P. and it didn't stop, but I've seen a lot of times where that is the stopping point. The ES has been there and passed it. The SPX has been there and passed it, but SPY not yet there. It finally gets there, and that's the end of the move. I've seen it happen. Didn't happen yesterday, but it's one thing that I was looking for when I was trying to answer that question. Could we fall lower? And that's what I was asking at 11 o'clock. And the answer was, oh yeah, we could definitely go lower because we're not there yet in SPY. So it's something to think about. One more data point that we can use. And it's not like you got to sit there and stare at the charts all day. It takes a moment to just jump over to SPY and look and ask, have you hit the ADR yet? Nope. Daily one standard deviation is at 77 points. This is a tool that goes directly to implied volatility values. So when these two start to move, we really have that increased volatility a lot sooner than the 21-day average does. The 21-day average, it just takes a while. It's a simple moving average. It's a simple math, and it takes time. But we can jump over to something like the VIX, and we can see that we are not below 15 or not even below 20 anymore. We're between 20 and 29, which is correction, deeper pullback. Now we get above 29 and we'll be in a protracted decline territory. We're not there yet, but we're certainly beyond the point of, oh, it's just a pullback. Now, the VIX is notorious for making a move and then completely reversing it, even radically large moves. So we're in that section that says this is more than just a pullback. We're getting into correction territory. It's deep, but this can change really quick. So let's get multiple prints on the VIX up there. Plus, we can look at things like backwardation and contango within the VIX structure. See how that lines everything up. For the ADR today, it's going to be a lot like yesterday. Get to the lower one, which means we've already broke through structure like the cog line at 55.11, the round number, and the lower ADR half. If we can get through that, we'll focus on the full ADR. Central pivot range, we are quite a ways from the weekly pivot. It's 2%. In the first week of August, we went 6.5% away. We're only 2%. So when we try to ask that question, have we moved too far, too fast? Are we due for some sort of mean reversion or linear regression, least squared method? Any sort of reversion back to the mean? Not yet. This isn't enough. This is just one little pullback. We need another 4% to even begin considering if we've gone too far on the week. 2% is nothing. Today's channel is lower than yesterday's, obviously. Price opened below that. That puts us in a bearish bias. The channel's really wide, which implies that we shouldn't break out, and that if we do, the breakout fails. Keep in mind that that has no weight or bearing against economic news and events. So if the data points today with the job numbers rattle this market and we continue to expand, it isn't going to care about this channel. It is an MDP that's a missed daily pivot. It's exactly like it sounds. There's a daily pivot right here and we haven't hit it yet. Counting it as a missed daily pivot won't help until tomorrow anyways. We just have to make it through today without ever having hit this pivot. For today's distance from that pivot, we're not even at the S1 level yet. if we could continue to fall before 9:30 and get below this S1, then it's less likely that we can come back and hit this floor pivot. Otherwise, if we go into the 9:30 open in between this channel, then it's a coin toss on whether we're going to hit the S1 or we're going to hit the floor pivot. We are at the put wall. It's the last line of defense. The volatility trigger is the last defense before the put wall. But past the put wall, we got nothing in the options structure. I'm still waiting on spot gamma to come out, but we're in a negative gamma. We're underneath the volatility trigger, and we're resting on the put wall. In a negative gamma environment, market makers have to sell into selling to remain delta neutral in their positioning. That aggravates the selling and increases how fast we can fall, and it lowers the chances of us getting a V bottom day. We'll see. The volume is elevated this morning. We can see the volume sitting around the 130 level. It's been quite a while since we've seen the volume at 130 or anything like that. So they are in here trading, and they're trading heavy. It's very likely that they're making some adjustments to the current contract, right? Because we're going to be swapping over to December in 2 weeks on the 20th. Well, we'll be swapping early, right? We'll probably swap on the 13th. And by the time we come in on that Monday, this will be the last week of that contract, and we'll all be on the December one at that point anyways. So some of this could be attributed to them already rolling into the December contracts, but not all of it, not by a long shot. Otherwise, we would be expecting that every time we have a contract change, and we don't get that kind of move typically. The moving averages yesterday weren't very useful. We can see the 10-day moving average was tested, but we just broke right through it relatively easy. The 20, we cut through it like it wasn't even there. Now, the 10-week, on the other hand, is where we found structure yesterday, and it's what we bounced off of going into the close. If you didn't have that 10-week on your chart, or if it wasn't even on your radar, think about doing some top-down analysis, right? Start out on the weekly, just take a couple notes, pen and paper, that old school thing. It works. That way you don't have a ton of lines all over your chart, but you still have key levels to keep your eye on. Right now, that old resistance and support is what we're messing with. It supported us, but now we're underneath it, and so it's now resistance. Any move to the upside's got to take that into the account. The problem with support and resistance, especially with the moving average or any sort of pivot, is you have to get away from it. If you've been cutting up and down through it, price has no respect for it. It's not going to be supportive or resistive. Now, it's been doing a relatively decent job the first couple of times that we tested it, but that liquidity up there is fading. We're getting a little higher each time we test it. I wouldn't look at the 10-week right now to be very supportive or resistive once we get into the actual regular trading hours. And I would think that the entire area is going to be just a zone or a magnet of chop. We can continue to cut up, down through there, and it's not going to be supportive or resistive in any way that we could trade with. It's got to be better than that, right? So before it can be that for us, we have to leave the zone and then come back to it, then expect it to be resistance or support if we get above it. We have a combo line down here at 54.16. A combo line oftentimes is multiple options structures, and Spot Gamma just calls it a combo line. It's a level of interest, but that's the last level that we got on the options side of things. And if it was a big key level, it would have a good name like all the other ones. Volatility trigger, zero gamma. They wouldn't just generically name it something like the combo line and have 8 different combo lines. $53.92 cog line. Funny how that just works out that way. A continued move to the downside will put us basically at 5,400 where we got a half back. Now there is another half back. 54.20. There's one more on the last big candle from our current candle, 54.67. All of those are valid halfback levels. Just to make it a little easier to see. There we go. That's a lot of halfback levels all tangled up together. But it highlights the structure at 5,400 really well. Sure, it's not spot on perfect, but pivots aren't anyways, right? They're areas where we would expect to see liquidity. On the breakdown side of things, we have a candle to mess with. It's last week's candle. $55.07. If we measure all of last week and project it to the downside, that's where we stopped yesterday. If that level doesn't hold and this bounce doesn't work, then the next level is 54.50. Ten-day, 30-minute volume profile. We have nothing here that we didn't already have. It's a classic P-shape profile at this point, since we have this narrow tail and we have this large distribution center up here with the point of control in it. A P-shape profile is supposed to be bullish. We'll see. In the textbooks, if you go through and learn about the different profile shapes, they talk about the P shape being a distribution with a leg out and then a rally back up, and like a V bottom day, and it just creates this narrow tail and then the large distribution. Well, we don't have the rally up yet, right? Or also in the textbooks, they'll talk about a market that's down here and then it makes a run up. So it leaves that narrow tail and then gets up here and has distribution. And that's the P shape, which again, they consider bullish. So we didn't build this P shape profile the way that the books cover, and I don't see it as bullish at this point. We do have a new VPOC since we cut through that one from yesterday. It's always worth asking, did the one that we have get recognized by price at all when we cut through it yesterday? it paused there momentarily. Most of the time, I expect a nice little bounce off of it, right? Maybe 5 to 7 points. We didn't even get that. We had like a speed bump, and that was it. But from 14 to 20, maybe we did get our 5-point bump on there. Yeah, barely 6 points. So sure, we got it, but just the scrappiest part of it. They're not supposed to be support and resistance. They're not supposed to turn price around and stop us from falling or stop us from rising. They're just places where we expect to see an interaction in price. And usually you can get a good 5 to 7 points out of that. We have a new one, 55.83. It's an odd place for this distribution, and it's misleading because we want to take all of this volume, even from Sunday night all the way into that little bit of day that we had Monday, and put it all together. If we did that, I think we would have 3 different structures, one down here in the lower portion, one here where the point of control is, and then we'd have another one up here. It does show yesterday where they really tried to turn everything around. And they gave it a good shot. You could see it in the options structure if you're watching on Spot Gamma, or maybe you ran the trading tick command and called up the options flow. They gave it a really good run, a good attempt at trying to turn it around yesterday in that area. I know it's odd to hear, but they don't know what the market's going to do any more than you do. They've got the ability to try to push it or turn it or influence a little bit, and they'll give it a try. But if it doesn't work, they just don't fight the tide, right? But they'll at least try, and they did yesterday. We'll see if they try again today. So any move to the upside today, we've got to get through this 55.83 area. I'm not going to call it resistance, but it is an area of concern. It's where the greatest amount of trading took place yesterday. And think about it from trader's remorse point of view. If you got in yesterday there, long or short, and we're back there today, what would you do with your trade? This is setting up as a failed flag. It's not failed yet, but a flag is supposed to continue on, and this is a bearish one, so we should continue to the downside. That's what we're supposed to do. But at some point, if we go sideways too long, the flag itself gets longer than the flag pole. And then it starts to imply that instead of a trend to the downside where we pause and flag and then down and then pause and flag and down, instead of that, that we actually start to form a bit of a cup. So we go down and we stay down here and start working our way back up, and we get a cup or a double top or something other than that continued move to the downside. I'm not saying we're going to go up here yet, just that the longer we don't continue to fall, the longer we stay here chopping about, the more likely it is that we turn and go back up, and that would form a really nice cup or that double top. Now, one thing that I like to do on these is just snap the range and put on a 786. It's my pullback level. How far does this market have to pull back before it's no longer just a pullback, but instead is actually a retracement back in the other direction? That would be 786. We ought to probably do this where there isn't a profile in our way. $55.44. And it's not a bad lineup anyways, because it gives you your buy zone down here. Where's liquidity if we continue to break down? And where's the next target? 54.32 cog line. But if we stay here chopping at these lows and we start to turn around and rise, how far do we have to go up before it's not just a pullback? 55.44. So that is the pull, and this is the flag. Yeah, that is a little bit of an inverse head and shoulders, but I wouldn't use that. That's not going to be very helpful. It's more useful to define how far price has to go as a structure. It's got to get out of this box. It's got to get above this. Now be careful, because it can wick up there and then come back down again, right? It needs to get completely above that and define itself like it's going to continue to stay beyond that level. Then we have the halfback, then the RTH open of yesterday, and then the high of yesterday, level by level. This works on the intraday too. We did it yesterday. It was one of the posts that I had put out on the pullback. How far up can this pullback go before it's no longer just a pullback? And it was, well, we need to stay underneath 55.94 or 55.92 cog lines, close enough. All right. Hey, no surprise. Semiconductors and Bitcoin are down the most. Biotechnology is also down. And then your general tech, gold, cloud services, Mag 7, growth. It may have been easier just to look at what's up. What's up? The China ADRs in the internet ETF KWeb. That's all we've got. Not very inspiring. So it says Bitcoin down, but not by very much, at least not BITO, not yet. It's really just kind of hovering in the range, but it's been beat down, right? So not really much on the Bitcoin front. Same thing with SMH. It says it's down. It's not really too much more down, just a little bit of gap lower. But that does get us to the anchor to VWAP. Maybe we don't get no biotechnology today. Oil and gas getting a little move to the upside. This thing's been a turd for a while, so I would approach anything in crude with caution. We got this nice breakdown here. And if we do just our normal measurement on this and we get a double bottom, it needs to go lower than the previous low to be the bear trap that it is. Otherwise, why would a bear get in there, right? Unless you can convince them, make them think we're actually going down. and then we squeeze them and pop their heads. So this measured move perfectly right to the 111, and it sprung the trap and has the bears in it. Now, if this trap can't get past the halfback up here or the anchored VWAP up here, then it's just going to fizzle out. And if you look at the last trap and trigger, it was a nice 3-day run, like a TRB setup, which failed, by the way, because it didn't make it back to the highs the way a TRB setup is supposed to. So it ended up with a higher low and then a lower high. And we broke all that structure, all of it. I wouldn't expect to get an equal high, let alone a new high here. BABA is up. JD and a little bit of PDD. I think a textbook bear pennant. So the China ADR is maybe up a little bit this morning, but it's not good. I wouldn't look too close in that direction either. Keep your eye on the bonds today, the bonds and the dollar. We saw some pretty big moves yesterday, but it goes back to Powell's statement that everything's changing, and we've got this sort of a H pattern on US dollar, Japan, NASDAQ, ES, 10-year, and dollars sitting in this topping pattern like we were sitting in last week, resting on that 10-day, which it fought to get back above last week. So it sold off hard, got under the 10. Now it's back above it. If it springboards from here and continues up through that 102, I think the market will start to change its dynamics with the dollar above 102. But it's been holding this range for 3 days. So that'd be one of the key things I'd watch for today is the dollar breaking the range up or down. If it goes down, it'll break the 10. So it's no longer on structure. And if it goes up, it breaks 102. And we're back into that previous run that we had in the dollar. Getting back above this would put us back in this previous structure between 102 and 103.5. How do we know when the put wall fails? Failure is an odd word. It's whether it's still there or not, right? If we're above it, it hasn't failed. If we're on it, then we're testing it. And if we're underneath it, then it's failed. But how far underneath it do we have to go, right? 15-minute candle close, 30-minute candle close. I'd say if you finish the day underneath the put wall, then the put wall failed. But fail makes it, and I'm sure it was my word that was used too, but fail makes it sound like it has a job to do, and and it didn't do its job. It is the last support level, not because it's a handrail or something to lean on, but it's because where we expect to see options monetized and a lot of money flowing in. It's like a buy zone. We expect that buying to stop price from falling. So if they don't buy there, does that mean that it failed or it didn't do its job? I'd say just that the liquidity wasn't there. They didn't want to monetize their puts there. They didn't want to buy calls there. And we continued to cut through it. I guess take your question to the next level. What would your action be if you decided that the put wall had failed? Now, we've been in zero gamma, and the zero gamma line rolled down. It wasn't there before. There's 2 AM notes that just came out. That's weird. Maybe they missed something on the first one and put out a second one. But we can be in negative gamma and not see them continue to sell into selling. They can stop at some point, especially if they think we're nearing a structural level where they don't have to do the buying, right? Or do the selling in this case. They've got a notional value that they need to cover their butt with, and they'll sell into that selling as long as they still need to cover their bum. But if they get ahead of it, say they sell more than they think they needed to sell because they think we're going to continue to fall lower, then they're ahead of the selling. They don't need to sell the next time we break down, for an example. I will get the founder's note shared, both of them. I'm not sure why there's 2 yet. Looks like maybe they accidentally hit the button before they were done and they were like, oh, wait, I had more to put in here. Pay particular attention to that founder's note this morning. They usually have a line in the sand that says it really needs to hold X level, whatever the level happens to be, or else. And you're going to want to know what their or else level is today. Everybody, be careful, be safe. I'll see you all tomorrow.